So here's how it works. So here's one just this past week. This was on Constellation STZ. And so this is how the trade structure works and kind of the steps that I go through looking at this, the history here. You can see the implied move, expected move history, just going back. I just went back like 4 series. You can see it's a low implied volatility move typically. So 4% was kind of the highest. So what we're looking for is just stocks that don't have the huge price spikes up or down. Don't want a big price movement up or down. Want to kind of be contained within a range. So you can see it averages about 3.5%. So perfect potential trade for this. And then you can see here STZ, it's Thursday earnings release after the close. And you can see here just going back 4 periods, 4 earnings cycles. The last one, it was up 2%, 3% down, flat, up a little bit. So not huge price spikes. So with this one, wanted to do the potential to sell volatility and do it with a double calendar because there's more potential for bigger profit as well. So the other type of earnings volatility types of trades will give you maybe returns of 30, 35%, maybe 40, 45, but this has potential to 100 to 200% returns potential with very low defined risk. So here was the trade setup. This was setup was on the 4th. It was trading at 242, and the earnings were going to be Friday before the open. So you'd have to set this up on Thursday afternoon. So it was trading at 242.33 going out on Thursday, and then the next day this was trading at the close. It was trading 247.51. So looking at the setup, it was the expected move was looking for a 3.5% up or down. So set the trade up for a 3% move up or down. So the double calendar at 3%. And you can see it had a kind of a little bit of a spike that came down. So it's trading right here when it was set up. You can see the volatility collapse. And so it went out right here. So a perfect setup. So this one was about as perfect as you can get. Now, obviously, all of them won't be the same, but this one turned out really good. So here it was going into the series. You can see here it's on the 5th of Jan was the expiration series. That was Friday, this last Friday. And so this was the day before on a Thursday. You can see the implied volatility had spiked up to 86%. Now, normal volatility, in STZ is about 25%. So we're going to, in this trade, play for that volatility crush. And so 242. And so this was a great strategy for that. And the next day, you can see it was at 247.53. It moved up, but not too much. And now you can see the implied volatility was back to where it normally is, around that 25. So it collapsed back to 27. So here was the trade setup. And what's so great about this trade is your risk is going to be always a lot less than the other types of trades that you might look to do. So on this one, the max risk was $150. So this was based on doing the double calendar. So you can see you have a put calendar and a call calendar. So the call calendar was doing the 247.5, 12 Jan long, short the 5 Jan. So that was costing, that calendar was costing $75.75. And then the put calendar side here was the 235 put calendar. So targeting down to that area, that cost 75. So the total cost or risk of the trade was 150. Now your break-even points to lose on these trades is, you've got a really good wide break-even as well. So the break-even point up was, if it moved 4% or higher, it never came back. Typically, so it'd have to gap to lose on this trade. It would have to gap up 4% here and never pull back. That typically doesn't happen. You might get a gap up, but typically they'll pull back at some point during the day, or a gap down of 5% right here. So this was an ideal situation. And then if you really, thought, okay, well, I think there's a great potential for, STZ to keep trending up or down, we can close out one side of the trade. We can close out the put side, leave on the call, and trade it for the next week, either up or down. So this gives you that opportunity, but it's the first off selling that volatility. So you can see the trade was set up here. Total cost was 150 for the double calendar spread. And then on Friday, the spread was going out. Now the spread was blew out to $330 per spread. The cost was 150. So the profit was $180 per spread, or 120% return on that risk of 150. So here you've got a potential to make over 100% return versus some of the other strategies that are typically done that are, going to maybe give you 30, 35, 45% return, and typically would be a lot higher risk trade. So